Let me put it to you this way. Even with my hedge being down, okay, this is why I wanted it, right? If the market dumped, it would be tough. But on my trading portfolio this morning, okay, even with my hedge, that's the whole point. That's the whole point.
Bear gang till I die, ho. Swooped up the homies and we about to start a sideshow.
All right, so I am going to take 5%. Okay, do not do what I'm doing, okay? Because this could end badly if you don't know what you're doing, okay? All right, I am taking 5% and I am buying UVXY with it, okay? Why am I doing this? Because if my equities dump tomorrow, let's say the market dumps 3% tomorrow, okay, and it's a lot of volume, the potential is my UVXY shares could potentially go 10% tomorrow, right? Which would be 0.5% up on my portfolio. I would be down 3% in equities, but 0.5% of it would be hedged. Then I would sell this, be down only 2.5%, which is fine because what do I know my equities are going to do in the long term? They're going to go up. So I hedge myself on the 2%. I should say 2% on volatility, okay? And it's going to be down 1.5%, okay? So if that's the case, I will hedge about 0.5% of my portfolio, okay? I'm going to take a little bit of short-term gain with the main loss happening, and then I know equities are going to return to value at some point, so I'm just hedging the single-day loss. If I'm wrong and the market explodes by 2%, okay, that means that I'm going to be up overall 1.8% because it's 95% of my portfolio, and I'm going to lose probably 50% of 0.5%, so that's minus 0.25%, right? So my gains are going to way outpace the loss I take because this is a small hedge. So I would rather this lose 50% in value, which it wouldn't. It would probably lose 10%, so it'd be down 0.05. But we're just gonna, for the sake of gain here, right? So if the market goes up 2%, I'm up 1.8% overall. I'll take that and lose 0.05%. But if the market dumps by 2%, I hedge 0.5% of that, so 25% of that on the upside with the hedge, sell that, and then my equities will eventually go back up. Basically what you're doing is you're taking a small bet, okay, that if you're wrong, if you believe you might be wrong, you don't lose as much this. But if you're fine and you win, you only take a small little bitty loss. You have a pizza. Everybody wants me to explain in pizza, okay? All right? You take 5%, you take a small slice of that pizza, and you put it in the fridge. Because you are taking your pizza and putting it on the counter, but you got to go to the bathroom and your dog is out there, right? You hope your dog doesn't eat your pizza. But in case he does, you've at least got you've still got some pizza left over. And you can always order another pizza, but you're not going to starve in the meantime. This is going to keep you full or filled until the next pizza comes. You hope the dog doesn't eat the pizza. And if he doesn't, you still get to eat all this pizza, and this gets bad in the fridge. Does that make sense? This little one that you put on the side is just to keep you filled up until you get another pizza. You don't want to starve. The pizza place isn't open till tomorrow. You got to eat something. So just in case, you put one slice in the fridge to hold you over. Okay? You hope you don't have to eat that slice because that means all this pizza's gone. But if the pizza does go, at least you have a slice to hold you over till the next pizza comes. Are you dumping your UVXY? Yes, but remember, guys, remember. Okay, I broke down on the whiteboard. I don't think I need to do it again. Exactly what I was doing with my hedge, why I was doing it, and why I hoped the hedge would lose money. That's how hedges work, guys. Overall, I'm still having a solid day. Let me put it to you this way. Even with my hedge being down, okay, this is why I wanted it, right? If the market dumped, it would be tough. But on my trading portfolio this morning, okay, here you go. Okay, even with my hedge, that's the whole point. That's the whole point. I would rather my hedge being only 5% dropping today. XPEV, destroying it today. Walgreens green again. Rocket killing it. PayPal $9 today. Pfizer is killing it today. Here is exactly why the market is mooning right now. And anyone who says anything otherwise is full of shit. I can tell you what's driving the market. Why is tech driving the market? In my opinion, one of two reasons. One, closer than thought. Meaning that if there's potential that Trump could win, means one, or A, corporate tax stays low. Also, B, Senate stays red, meaning the chances of corporate tax staying low also stay. Why is that important? Corporate tax is the amount of tax corporations pay. What are the biggest corporations in the world? Tech corporations: Google, Amazon, Apple, Microsoft, Netflix, these companies. So either Trump has a chance of winning, or because the Senate stayed red, which was, there was a lot of uncertainty, boom, there you go, corporate tax stays low. The chances of it staying lower there, tech corporations are running. Or number two, which is what I'm leaning towards, still no results, official results. Okay? Which means until those results come in, Wild, Wild West, baby. Wild, Wild West. Fuck it. We don't know what's going on. Let's buy the shit out of this today. Let's buy the shit out of this, because we may not know until end of day today. We may not know until tomorrow. We know about Friday. We don't know who's going to be president. And you know what? Everyone's scared. Everyone's selling off out of uncertainty. We're going to go in and buy this shit up and then resell it to everybody else. Because guess what? Nothing's going to happen. Nothing can happen. No policies are going to go through right now. So fuck it. Let's buy. Let's buy. Let's just take this day and buy as much as we can. Tomorrow, if there's still uncertainty, we go again. That's what I think. But anyone in this chat or on TV who tells you they know why it's going up is full of shit. Okay, a lot of people have this fallacy that the gold goes the opposite of the market. It's a hedge against the market. No, it's not a hedge. I'm not hedging against my portfolio. So what I'm looking at, okay, is what are we looking at as far as our currency, right? The dollar's very strong. The dollar stayed pretty strong. But what causes something to lose value? What causes something to lose value? More supply than demand, or an abundance of supply, or a rise in supply against demand, right? So we had a $1+ trillion stimulus. Okay. Europe did a $1 trillion stimulus. Okay. We're looking at another stimulus. Now, how much that stimulus is what matters, right? So if the stimulus was 1 trillion, and I'm talking about in the hands of the American people, then there is $1 trillion new dollars flowing around. That's not crazy. It'll cause some inflation or some devaluation of the US dollar, but it's not crazy. But every trillion you add to this, you water down the value of a currency. Good, bad, your opinion, but that's what happens, right? So the idea that with a Democratic president and a Democratic House, the leverage to pass a more robust stimulus, 2 trillion or more, increases. If for some reason the Senate does, which it most likely won't, but if it does go blue, then you've got a full blue house, and there's nothing to really, the checks balances part there, and we could see 4 or 5 trillion. As that concern, I shouldn't say concern, as that likelihood becomes more that the stimulus will pass and it will be significantly higher, gold futures are ticking up. Because people are anticipating the rise in the value of gold, right? Because gold is what people move their money into to hedge against the value of the dollar sliding. So that's where that concern is. Obviously, some people say, well, cryptocurrency does the same thing. I agree, but I'm a boomer. Okay, I like the GLD, right? So we're seeing gold futures every single day since the election creep up. Okay? So that's where I'm looking at. So this is why we're seeing gold creep up. And I think it will continue to creep up. So I'm looking for a entry in a play against gold. There's level, you can, there's physical gold, there's gold companies, there's gold miners. Some people like to play the miners leveraged as well. I like GLD because it's an ETF that follows the price of gold. So that's kind of what I'm looking at. That is why I am looking at this entry to play. I'm looking at, and I know that I shouldn't tell exactly what I'm looking at, but I'm personally looking at $200 January GLD calls. That's what I'm looking at. I'm not looking to hold. I'm not looking to hold to January. I'm looking for a 20% return on that. So that's just what I'm doing and what I'm thinking and what I'm looking at and the reasoning behind it. That's what I'm giving you guys, okay?